Hello, everyone, and welcome to BFW 2401. This is an explanatory video for pre-class activity number 5 and the last pre-class activity in this semester. Now, this pre-class activity is concerned with capital adequacy requirement and capital adequacy regulations. Let me just start with you with the issue of why bank capital is important. And as you know, since we started this semester until now, we understand that the capital is buffer for the risks. So if you take more risk, you should have more capital. So if unexpected losses happens, in any ways, you have enough capital to pay for those losses, and in this case, to prevent the collapse of the bank. Collapse of a bank, especially when you are talking about big banks, then you will have a ripple effect and systematic risk, which will affect the whole banking industry and the whole economy. This effect can be on the local basis, regional basis, and if you are talking about huge banks in huge countries, like what happened during the financial crisis, it can be spread over all the world. Now, let me just preview a little bit about the story of Basel. Before 1989, actually, we started with Basel I. Now, Basel I was about having 6% of assets to be a capital, regardless whether the bank risky or not risky, whether the bank is big or small, it doesn't make any difference. This is the whole thing. Then that one was dealing only with the loans and the credit risk. But then they expand that to include also a market risk. For example, if you have a bank that is operating in a country where the market is actually of that specific country is risky, then you have to incorporate that in the capital, regardless whether you are giving good quality loans or less quality loans, you will be affected by the market. And then they expand that to the operational risk, which means how the bank operations inside and whether the operational risk as we defined it before, which is the failure of the people or the systems or all those issues. And they have certain models to manage that operational risk. So we ended up with Basel II, which include credit risk, market risk, and operational risk. Then the financial crisis 2008 came. And when the financial crisis came, they came also with its problems, and it produced so much consequences after that. And when there is a crisis, there will always be regulations. So they come up with Basel III. So Basel III introduced and enhance the three pillars. So we have pillar 1, which is section 1 of this regulations, and section 2, pillar 2, which represent the section 2 and pillar 3. We are dealing with how much capital you should have, which is actually pillar 1, which is the capital ratio, to decide how much capital you have. Because when they introduce Basel II or Basel III, they try to make some type of risk, some type of measurements of the risk of the bank, and then accounting the capital requirement for the bank according to that risk. So Basel III came up with the same story and added something for the capital ratio, which is pillar 1, which I was talking about. They added something called buffers. So they introduced 2 buffers. All in all, the capital increased from 8% requirements of the total assets, 6% in Basel I, 8% in Basel II, and it becomes, with the buffers, around 13% in Basel III. This is a huge percentage. Now, this is the story of Basel. Now, the other thing is in Basel 3, Basel 1 is related to the ratios. Basel 2 is related to the governance inside the bank. And Basel 3 and Basel 3, which is section 3, is related to how much information should the bank disclose. We in this class only dealing with Basel 1 and how we can do it. Now, what is the issue of this pre-class activity, having said all those issues? In Basel 3, they introduced something called the sunrise model, which we are studying it in the tutorial and also in the tutorial and in the workshop that I will release for you, an old workshop. And the other thing, they introduce also internal model, which means internal model, the bank can itself calculate this, how much it's risk, and based on that, they can have their own risk for their own specific bank, which is very good thing to do if you have the expertise and you can estimate all those risks with the coordination with the regulators. You can decide how much risk, and you can ignore a little bit what you call sunrise model. Sunrise model, they will give you tables from Basel and Basel committee, and then you have to apply those tables, and you can get to the rest, but that one is not as specific if you have the expertise like the internal model, which the bank internally can provide it. Now, what is the story now? We have three players. One player is the regulators. Second player is the banks, which is the industry. And the third player, of course, is the consulting arms, which is actually the those something like this big four. Those are actually interested in Basel 3 because they are the ones who also like those auditing high audit companies, big four audit companies and other audit companies and firms who are actually auditing the banks. Now, and this specific pre-class activity, we are dealing with those three parties. So the videos which I provided to you, one from the industry, one from the regulator, which we call it Bank of International Settlement, BIS. This is where Basel Committee is actually coming from. So BIS is actually the secretary of the Basel Committee. Now, Basel Committee is actually the top central 20 banks in the world who decides on this regulation. Now, having said that, just to bring you a little bit to the case which we have, if we know that we have in Basel III internal model, and they were happy with that, especially the European banks, and the what we call the sunrise model, the industry, which is the banks, were not really happy with the sunrise model. So if they have the expertise, and most of them have the expertise, they were able to calculate the internal model and count the risk according to that, and allocate the capital according to their risk. Starting 2017, we have a new issue, which is the Basel IV. Basel IV is actually trying to make some improvements from the perspective of BIS, the regulators, which is the Basel Committee. So they say, okay, for the internal model, you can still use the internal model, and this is the main disagreement going on now, and they want this Basel IV to be established and come to effect from 22, and now it's 23, now maybe 24, and that will continue to 2030. Now, by the time you graduate, maybe you will not see Basel 3, but you will see some sort of Basel 4, which is actually a development of Basel 3. The main disagreement now is the banks actually are insisting to use the internal model and they want to keep it. The regulators want this internal model to continue and what you call this sunrise approach to continue. But if you are going to use the internal model, it should have at least a cap floor, which is 70%, 72% of the sunrise model, which means if you use sunrise model, fine. If you are going to use the internal model, you can use it, but up to, you cannot decrease the capital from 72% from the sunrise model, which is actually a big problem. Now, this argument is going on between the following, between the regulators, BIS, between the bankers or the banks, specifically in the European Union, and they are lobbying for that, and also for the third party, the third stakeholder in this issue, which is actually the consulting firms like the Big Four. And this pre-class activity, I brought you 3 videos. I brought you a video from the bankers and their opinion, and from the regulators, which is BIS, which they think they are good. The banks think it's not good. And the third one is from PwC, which is one of the Big Four. This is explaining the issues of and the framework of Basel IV. All I want you to do is to take some time, and as usual, you write for me in an academic way, do some research, and take the argument of the 2 main parties, the industry, which is the banks, and the regulators, which is the BIS, which is actually the secretary of Basel Committee, which is the international regulators of bank capital. In that argument, please put your input and bring some critical thinking, do some research, and there is no right and wrong, as I told you, but I think by doing this, you will be understanding what is Basel III and what is the progress that would happen by Basel IV. And of course, you are already understanding this story of Basel III, of Basel Accords or Basel regulations from Basel I to Basel II to Basel III. That's all, and I think you will do well. There is some other questions, which is actually about the local regulations and Malaysia, and maybe in your country, if you are an international student, that is just will be taken in the multiple choice questions. But the main and the core one is actually this argument between the industry, which are the banks, and the regulators. Thank you very much, and enjoy this process, and hopefully it will benefit you when you graduate. Thank you, and see you in the last tutorial. Bye-bye.